Hello, I'm Kristen King, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. This week, in the wake of news that a viable coronavirus vaccine is within reach, we're asking, should investors continue to own gold? Gold is up over 20% year to date, and it was driven higher by a combination of political and economic uncertainty created by the coronavirus. According to Trackstar IQ, our proprietary search tracking tool, 39 institutional investors have been researching gold ETFs over the past week. However, in the last week, gold has given up 3.72% and is now almost 9.5% below its all-time high at $2,070 per ounce. The precious metal acts as an alternative form of money and a store of value. Traders and investors use gold as a hedge against uncertainty, the potential for inflation, or a weaker currency. The pandemic created those very conditions. The federal government and the Federal Reserve have pumped trillions of dollars into the U.S. economy during 2020, and there may be more to come in the new year. In fact, let's take a look at the growth of the money supply in the U.S. using the M2 benchmark, which tracks cash, near cash, savings, and money market accounts. We find that more than 20% of all the dollars ever created were created in 2020, which is quite a staggering statistic. Despite that enormous additional injection of cash, the rate of inflation in the country remains well below its pre-COVID peak and has started to turn lower once more, coming in at just 1.2% in October. So, if the economy is going to reopen over the next 6 to 12 months and inflation is falling, is there still a case for owning gold in a portfolio? Investment and private banking group UBS recently wrote about gold. They reminded us that the introduction and timing of a vaccine would likely be linked to a rotation out of growth and into value, which is the so-called reflation trade. That rotation might tie in with a second stimulus package, assuming that a Democrat-controlled White House can work with Congress to push some or all of the proposed $2 trillion package across Capitol Hill in the early part of 2021. One of the reasons that U.S. consumers have been focusing on essential purchases, paying down debt, or saving money if they can, has been rising unemployment and an uncertain future. However, if a route to normality opens up in the new year, then consumer sentiment and spending may improve, and that in turn will help drive demand throughout the economy. Let's not forget that U.S. consumers and their consumption account for 70% of U.S. GDP. U.S. government borrowing has also been rising during 2020, and that looks set to continue in 2021. And while the cost of borrowing remains low for now, it is starting to rise. Increased borrowing and government spending have helped to weaken the dollar this year. The trade-weighted dollar index that measures the performance of the U.S. currency against those of its largest trading partners is down 9.77% year to date, and currency markets are not currently pricing in a bounce for 2021 either. Continued dollar weakness and low U.S. interest rates should also benefit gold prices. However, probably the biggest boost they could receive would be a jump in employment and wages, which would signal widespread economic recovery. In summary, it does feel gold has lost some of its luster over recent weeks. However, the macroeconomic background in the U.S. is such that even if we see further short-term weakness in the gold price, we shouldn't rule out the possibility of a medium to long-term rally for gold. As the U.S. economy reflates and starts to grow once again, more money rotates into value stocks and real assets, of which gold is one. What we can't be sure, of course, right now is the timing of that. That's all we have time for today, folks. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/trackstar. As always, make sure you do your own due diligence before making any investment decisions.